Well, hello and welcome to the launch of Walking the Path to the Next Global Financial Crisis, our new report by Bryce Wilkinson and Leonard Hong. My name is Oliver Hartwich and I'm the Executive Director here at the New Zealand Initiative. It's a great pleasure to welcome our two speakers, Dr. Bryce Wilkinson, the co-author of our new report, and Sir John Key, who I'm sure barely needs an introduction. Before we get to their presentations, just some housekeeping. We'll be taking questions for Bryce and Sir John via Slido. It's easy to use. You log on to slido.com, you use the code 643327 and let us know what you would like us to discuss. You can also vote on other people's questions and I'll be putting the most popular ones to Bryce and Sir John. Now to the topic of today's discussion and indeed the topic of our new report. We want to talk about a major crisis, not the one that is COVID-19, not even a crisis that is currently happening, perhaps a crisis that may not even happen after all. We want to discuss the chances that there will be another major financial crisis. We all remember the last one, the global financial crisis, or GFC, which happened around 2008. Back then, we had banks like Bear Stearns and Northern Rock and Lehman Brothers collapse. We saw the collapse and near failure of insurance giant American International Group. We saw how whole countries like Greece, Italy, Spain, and Portugal were about to collapse under their public debt. And we saw share markets crash, unemployment soar, and economic activity plunge. The question we're asking today is simple. Are we likely to see a repeat of the GFC over the coming years, or is this time different? To discuss this, we are fortunate to have Bryce and Sir John with us, who will bring their life's experience to the table. Bryce is a senior fellow here at the Initiative and our most experienced colleague. He's also the Director of Capital Economics. Bryce used to work in investment banking with First New Zealand Capital, and he was also a director in the New Zealand Treasury. Bryce holds a PhD in economics from the University of Canterbury, and he was a Harkness Fellow at Harvard University. And with his decades-long background, he's one of New Zealand's most experienced economists. And as I said earlier, as a former Prime Minister, Sir John Key does not need much of an introduction, but I want to highlight that Sir John, of course, does not only have the political experience of having led New Zealand at the time of the GFC, he also has experience in banking and international finance, both before and after his time in politics. So before entering politics, Sir John worked at Bankers Trust in New Zealand and Merrill Lynch in Singapore, London, and Sydney. Between 1999 and 2001, he was a member of the Foreign Exchange Committee of the Federal Reserve Bank of New York. That was right as the dot-com bubble burst, and I'm not referring to Kim.com, that came later. Today, among other directorships, John chairs ANZ New Zealand and is a director of the ANZ in Australia. Welcome to both of you. As for the proceedings, Bryce and Sir John will speak for about 10 minutes each. We'll then have time for questions. Once again, welcome to you all, and over to you, Bryce. And you have to unmute, Bryce. Right at the bottom of your screen, on the left-hand corner.
Okay, thank you.
Got you, great.
Thank you, Oliver. The focus of this report is on what is weird and dangerous about the global financial system. How did this happen? How might it evolve? And how might New Zealand respond? Governments in the world's major and most prosperous countries are spending money that they do not really have to spend. Their central banks are behaving like bottomless ATM machines. In responding first to the GFC and now to COVID, these governments have ratcheted up their peacetime public debt ratios to an extraordinary degree. Astonishingly, for peacetime, in just 3 years, US officials expect the US public debt to exceed its all-time record high relative to GDP. That record high was caused by World War II deficit spending. That was understandable. Normally, the cost of servicing record or near record public debt would be a major problem for governments. Not so in today's weird economic times. The major central banks have been doing everything they can to keep the cost of borrowing down. They have pumped trillions of their currencies into the global financial system, and they've set up set their own interest rates at record lows. The Bank of England is the world's oldest central bank. It was founded in 1694. The orange line in the chart shows its official cash rate back to 1697. Today, its cash rate is 0.1% per annum, the lowest in its history. The blue bars show its total assets and liabilities relative to GDP. This is a useful indicator of how much cash it is pumped into the UK banking system. On my estimate, in February 2021, its balance sheet was 42% of GDP, more than twice its previous maximum, which was way back in the 1730s. The word unprecedented is not too strong to use to describe the current time. Governments and major central banks justify this for now as a valid response to the COVID epidemic. Their hope is that strong economic growth, continuing near zero interest rates, and future fiscal austerity will gradually overcome the public debt problem. In the report, we fear that this debt situation will still be dire when the next economic downturn hits. To keep ratcheting public debt up and net worth down is to walk a path to disaster. To hope that this time it is different is delusional. History shows that an excess of private and public debt is always dangerous. One current sign of danger is buoyant assets amidst recession. Look at the US. Last year, its response to COVID saw the biggest one-year decline in its economic activity in over 60 years. Its unemployment rate more than doubled. Usually, we would expect to see company profits to fall, asset prices to weaken, and households to feel the pinch. We would expect bankruptcies and insolvencies to rise. Yet the S&P 500, a major share market index, has been hitting record highs. In 2020, US household wealth rose by a record $26 trillion, and that's 23%. To put that in perspective, it is a bigger increase than if US households had saved much more than the country's entire national income in that year. That is weird and bizarre. What that statistic is showing us is the extent of capital gains from easy money. To understand how household wealth can increase so much amid serious recession is to start to understand how dangerous the situation is. In a nutshell, the US has been running major public deficits, bigger public deficits than in its response to the DFC, and the Federal Reserve has been pumping in money. That increases the money supply and also indirectly helps fund the US government budget deficits. And the US, unfortunately, is far from alone in these respects. Why is the system so? The system is potentially addictive for borrowers. For those involved, the arrangement seems sweet and painless. People have more money in the bank. They feel good about that. Government also feels good. It can apparently spend as much as it wants without having to raise taxes. Central bank credit is potentially addictive. Three aspects sweeten this heady cocktail. First, the banking system has no option but to deposit back with the central bank the money that the central bank's ATM machine has injected. These are captive deposits. The second sweetener is that the banks must accept whatever interest rate the central bank sets for these captive deposits. The less positive or more negative the interest rate, the greater is government's incentive to borrow even more. Just take a moment to imagine that as a government borrower, you can dictate how much the banking system must lend to you, and you can dictate the terms of that lending. You can even make the interest rate negative. What borrowers would not get addicted to debt under that regime? Three central banks have actually set their interest rates negative. That's Japan, Switzerland, and Denmark. Other major central banks' policy rates are not much higher. The European one is 0. The US Federal Reserve's one is 0.125% per annum. that barely exceeds the Bank of England's 0.1%. As a result, governments in the most prosperous countries have been able to increase their public debt ratios to GDP while reducing their borrowing costs. The report shows this for about 5 different countries, but in the chart, I'm just showing you the Eurozone group. And that chart shows that back in 1993, borrowing costs for those governments as a whole were about 4.8% of their GDP, and their debt was only 43.5%. The debts escalated up through the global financial crisis and again to reach an estimated 76% of GDP in 2020. But the cost of servicing that debt has drifted down to only 1.3% of GDP. This is a remarkable and unusual phenomenon. The third seductive and destabilizing aspect of the current time is that low interest rates and more money in the bank encourage firms and households to bid more heavily to bid up asset prices. So households can feel richer amidst recession because they have more money in their bank and their other investments are worth more. If you are thinking this looks weird and fragile, you are sharing our concern. What we are seeing is the outcome of a debt-fueled money creation process that can cause household wealth to rocket up despite serious recession. And here is the really dangerous bit. If all this is a good thing, why is more of the same not even better? Moreover, if it is a good thing, surely doing the opposite is a bad thing. The problem is that people are coming to expect that the authorities will do whatever it takes in their desperation to avoid the next collapse. That's the monetary authorities. Governments are running large fiscal deficits that reduce public net worth for much the same reason. So now both are in a bind. Not to take corrective action is to continue to dig themselves into a debt hole, but to do so risks precipitating a major downturn. Meanwhile, investors are bidding up asset prices because they think the authorities are underwriting the risk. That is the dangerous expectations. How did the world get into this situation? The report traces the path from the Great Depression of the 1930s to the end of the last remnants of the classical gold standard system in 1971. The stagflation of the 1970s was followed by painful disinflation in the 1980s. And there was much more moderate and better income growth and low inflation once the central banks adopted inflation targeting around the world. But during the 1990s, the seeds of the next rot were set. The terms the Greenstand put, too big to fail, and later do whatever it takes, became common financial market parlance. I am tempted to call the current period the Great Desperation. I see central bankers and governments as being like the fabled Dutch boy who saved Holland from disaster by putting his finger in the dike to block out the seawater. Eventually adults arrived and saved him by plugging the hole. The problem here is that the US, Eurozone and UK are the only adults in the system. No one else can bail them out. Only they can restore normality, but there's no real sign at the moment that they're up to the task. Where to from here? The report considers 4 possible scenarios. The optimistic one is mainstream, but implausible. It is too much like borrow and hope. The next 2 scenarios envisage a long haul of low growth and relatively high unemployment. The 4th scenario is a major crisis of 1930s dimensions. No one wants that, but will the major nations avoid it? The report leaves it to readers to assess what is most likely to happen, nor does it try to predict the time for any crisis. Professor Arthur Grimes' foreword suggests it might be sooner than we might think. What about New Zealand? New Zealand cannot affect the global events. We're too small. All we can do is take precautionary measures. Households and firms should not borrow to the hilt to buy assets that are overpriced because of central bank extremes. Government should stop spending wastefully, and it should much more actively reduce net public debt. A well-designed fiscal council would help Parliament hold governments to account for the quality of their spending. The Public Finance Act needs better enforcement. The composition of official overseas reserves should be reviewed, particularly the balance between gold and US dollars. And the Reserve Bank's mandate should be narrowed to focus it on genuine stability of the price level and of the financial system. That ends my explanation of why we are deeply troubled by the international situation. We have no crystal ball and are keen to hear what others think, particularly Sir John Key. We greatly appreciate his willingness to contribute his wisdom and knowledge to today's discussion. Back to you, Oliver.
Thank you very much, Bryce. That was all extremely optimistic. So either we'll muddle along, or we'll have stagflation, or we'll have a proper crisis. So I really wonder now what you, John, will make of that. We look forward to hearing from you, from all your experience. Are we heading towards the next financial crisis? What's your assessment?
Well, kia ora tātou. Firstly, thank you, Oliver and Bryce, for allowing me to be part of the launch of Walking the Path to the Next GFC. And if I can give a 10-second plug to the initiative, Oliver, you'll be pleased to know you didn't ask me to do this, so your listeners can not feel any way worried. But I think that New Zealand needs not only the New Zealand initiative, but arguably more think tanks. I think you add a lot to the democracy we live in. You challenge and you contest ideas. Australia is blessed to have more of them. And actually, I think it's a very robust thing. And even when you're Prime Minister and you're in government, and maybe the advice sometimes that you get or the reports that are there aren't always the ones you want to read, I think that they add to a vibrant democracy which is better equipped to cope with the challenges we have. So keep doing the great work. Bryce, I just want to acknowledge you. I mean, you've given a lifetime of thought and analysis and brilliance, I think. And I remember first meeting you back in probably about 2002 when I entered politics with the then late Roger Kerr, and I found you two of the most fascinating and annoying people I could ever imagine in my life. And I say that because you guys had the capacity to never get agitated with the counter arguments I'd put up or the ideas that I might bring in, but simply to sit there with great humour and with great calmness and destroy my particular counter arguments with real history of what happened in analysis. So you've made a great contribution to New Zealand, Bryce, and we obviously miss Roger. There is an argument that people say, a stop clock is always right twice a day, and so I don't think I come on this call to sit there and say there will be a GFC tomorrow, or there has to be a crisis coming, or everything is wrong with the world per se. But I think that what the report canvasses, and Bryce has touched on many of these issues, cannot be ignored. The simple reality is they present the ingredients to what could be a very dark time in our economic future if we're either not careful or lucky. And I think the first of those sit around the level of government debt. There's been a view, I think, for a long period of time that just the level of debt doesn't matter. I think that certainly cannot be the case in a country like New Zealand. I can tell you one of the reasons why our government spent a lot of time trying to keep debt under control was because not every country is treated equally. We're a little country at the bottom of the world. We've always paid a higher price and risk premium for the debt that we borrow. The higher those debt to GDP levels, the more exposed you become, and in a GFC they are showing up to be even more. So I do urge caution around the level of debt we take on. Obviously, you need to take debt down and to borrow money in times where you have particular issues like a pandemic or whatever, but we just need to be very careful about spending every one of those dollars wisely, because one day we have to pay them back. But I do worry about that, for instance, US debt levels, for instance, are enormous. and they're mirrored around the world. And I hear the argument sometimes that says, well, government debt can just be written off and there'll be an agreement amongst countries to write that debt off. Well, the history shows you the levels, that debt is owned by a private sector borrower more often than not. And therefore, why would that private sector borrower, whether it's a fund in the United States or somewhere else in the world, take that hit? Countries that have written debt off, Argentina, Venezuela, you can name them, have themselves always been in a crisis. So that's one thing. I think secondly, the level of private sector debt is high, extraordinarily high, and runs risks. And I'll tell you this story just because it's not enlightening, but it just gives you a sense. But when petrol prices go up in a country like they are at the moment, it doesn't take very long for someone to call talkback and to say, well, the government earns GST off petrol prices, fundamental petrol prices have gone up. Therefore, the government earns more GST, and what it needs to do is cut the GST level on petrol because it doesn't need to earn more revenue just because it's rising in its base price. The problem, and what the caller doesn't understand, is that what actually happens is that the GST level increase that you're getting through petrol reflects itself in lower spending in other parts of the economy, whether it's on food or other niceties in life, whatever it might be. And so what ends up happening is the government's overall GST take in dollars doesn't actually change. The reason I tell you that story is it shows you that the vast bulk of people live to the maximum of their income. And as chairman of ANZ, I can tell you we've done some analysis. Our parent in Australia has done some analysis. Enormous numbers of Australians and New Zealanders, I think something like 40% went into the pandemic recently with less than $5,000 in the bank. Very low levels of savings. So if you take New Zealand and you look at inflation and look at that globally, and you make the case as now Adrian Orr is that interest rates will have to go up, it doesn't take too much to realise how much pressure that is going to put on households. Already, ANZ raised its rates this week. We raised them a couple of weeks ago. You've got floating rates looking like they're going to go up again very soon. There's going to put a lot of pressure on the economy, and you apply that globally, where you've got people with very large levels of private sector debt, then I think that's a real risk that's there. I think another thing to think about is there had been a time where central banks solely used monetary policy. That was the tool in the toolbox. That was all they used. In recent times, what we've seen is a far more extensive toolbox. And you can argue that's good. We've seen that in New Zealand, where you've had everything from funding to lending programs right through to all sorts of different initiatives. And sometimes when people say to me, well, asset prices just have to fall and interest rates have to go up, I sometimes make the case, well, the central banks have thrown the kitchen sink at keeping the economies afloat. Having spent so much money, why will they change now? But maybe there is an argument that says there can come a time where even central banks lose the support of, if you like, of the private sector, or the belief that they actually can solve the issue. They can, in fact, run out of tools themselves, and where those tools just become ineffective. And so I think we do need to think about that issue. Inflation, I think you've all touched on, but there is a very healthy debate going on worldwide. In Australia, you've seen Philip Lowe really arguing that inflation is very transitory, that he doesn't think that he's going to have to raise rates till at least 2024. It's been quite a different position over here. But if inflation is in fact much more embedded than we think, and there's certainly lots of arguments about why it might be, from everything from logistics right through to wages now and various other constraints in the economy, then you really could see quite a substantial adjustment required around interest rates. And there's no question that that is a precursor to some very difficult economic times. I think it touches on the point that you made earlier, Bryce, around asset prices. I mean, at one level, we all marvel at some of these things. If you're the vendor selling a particular business at some amazing, multiple, even if you're the vendor of a house at the moment being sold around the country, you might be delighted with the price that you're achieving. But the question is, are asset prices sustainable, and are they realistic, and do they represent value? And if they don't, then again, in some sort of bubble or recession, then you can see tremendous movements in asset prices. And I think banks are notorious for measuring their risk in what they call the VAR risk. But VAR risk looks at the amount of volatility and likely kind of air pocket movement in a prescribed period of time, which is actually quite short. And in fact, when asset prices have gone up so much, as I saw someone commenting, might have been Sharon Zollner, the chief economist at ANZ the other day, if house prices fell 10%, it'd be called March. I mean, these are very, very big movements now that we're seeing. One of the things that I'm not sure the report canvasses a lot of, but geopolitics, I think, is an interesting place in the world at the moment. There's no question that there's a lot more tension. The China-US relations is always going to be different with Joe Biden than it was with Donald Trump, but the fundamental position is the same. There's growing tension. There's concerns being raised about what might happen in Taiwan, and there's been ongoing concerns in Hong Kong. I personally have never been a great believer that actually the aggression that some people argue China would show will actually present itself. But there's just no question that geopolitics is and the tension is growing globally. And then finally, while we are 2 years on in a pandemic and 2 years, I guess, more knowledgeable in terms of how we might deal with COVID-19, it continues to surprise. It has elements that are still very unknown. And so, I think the pandemic just adds another dimension. It certainly weakened the balance sheets of central banks and consumers around the world. So really, I sort of want to finish just really by saying, I'm not arguing there'll be a recession tomorrow, but I am saying that a sane person would look at all of the ingredients of what they see in the world today. And, whenever we have seen a crisis before, there was the sort of debate that you're seeing held now. The dot-com bubble saw enormous discussion about the valuation of these dot-com companies. When we saw the meltdown in the GFC, it was plain for everyone to see what was happening around. Products should never have been marketed like subprime mortgages. It was clear to see years earlier when you had the kind of leverage in banking institutions like long-term capital and the sort of leverage and debt you were seeing and risk being run, some of the banks and trading houses, all of these things were on display. And I think what you can point today is at least a number of similarities there where there's enormous leverage in the system. So, I think we're in for a healthy debate.
Well, thank you very much, John, and thanks indeed to both of you for your presentations. We now have time for questions from the audience, and we've got a big audience today. We've got almost 400 people on the call at the moment. Just as a reminder, you can log your questions on Slido, and the code is 643327, and then 643327. First question actually came through a different channel, but I want to ask it anyway because it's a good one. We've got a question from Emmanuel asking that all of the points made would have just as well applied at any point since 2012, and not even COVID could undo the system. So what will expose the frailty and cause the next crisis? Maybe first to Bryce and then John.
When the system gets fragile, there are a great many things that can tip it over, and it can be very surprising and not what you'd think. John's already mentioned the tensions between over Taiwan between China and the US. That's one possible source of shock. In the last few weeks, we were wondering whether the defaulting going on in the Chinese property market was a possible source of a trigger of a reassessment of risk around the world. At the moment, that's not happening. I've always been worried about Italy. It just seems to be a major cop case, and every so often the spreads on Italian bonds start widening sharply relative to, say, German bonds. But so far, the European Central Bank sort of been stepping in and effectively bailing Italy out. On some of the data we cite in the report, it's actually been more than funding the Italian government budget deficits by the amount of Italian government bonds it's been buying. Well, that's not sustainable, and it's rather dubious legally and morally for the euro to be doing that. So Italy is another potential source of risk, but you know, the long experience is that what triggers a reassessment of confidence and a loss of confidence can be quite unpredictable, and before the event it might have seemed too superficial, too small, too insignificant to be able to do what it turned out to do.
Thanks, Bryce. Same question to you, John, but perhaps with a slightly different intro. You've been around long enough to have seen so many crises, and my impression is that the crises are getting bigger each time. I mean, we had the 1987 stock market crash and we thought it was terrible, and then we had the Asian crisis in the 90s and it was worse, and then we had the GFC and it was absolutely terrible, and now we've got COVID, but they seem to be getting bigger in magnitude. So is that the difference now between today, where we are in 2012?
Yeah, I mean, I think firstly, a lot's changed since 2012. I mean, central banks have, as I said earlier, deployed lots of different techniques, certainly printed a lot of money, pumped up the money supply enormously, and governments have borrowed tremendously in that 8-9 year period. So are their balance sheets weaker or stronger from 9 years ago? Arguably a lot weaker, I think. So that's the first thing. I think secondly, we live, what COVID has shown, we live in a very globally connected world, and the way that the pandemic traveled around the world extremely rapidly, we've also seen that we're very interconnected from a manufacturing and from a logistics perspective, and you can see that, for instance, with the debate around semiconductors and you know what pressure that's been putting on supply chains and the tech sector. I think the other thing that's always worth remembering is that the markets are very fickle. We always used to say when I was back in the banking days, you know, buy the rumor, sell the fact. But what things matter till they no longer matter, or they're supportive till they're no longer supportive. I remember the very early days when I started trading. On Friday, New Zealand time, the M1 money supply would come out of the US, and everyone would sit glued to the M1 money supply. And whatever indicator it showed, one way or the other, we would trade off the back of that happily, and away we'd go. And one day it came out and the whole market just chose to ignore it. You know, if we should have been buying dollars, people started selling dollars. Because why? For no good reason. It matters till it no longer matters. Right at the moment, there's enormous confidence, I still think, put in the central bank's capacity to resolve the issues, and for governments to endlessly borrow money, and for consumers to feel comfortable. But, you know, it's a weird world we live in. You know, as you pointed out, every decade or so there's a recession of some sort. And something that's not significant or deemed to be significant today can turn into being extremely significant. So, you know, all I'd sort of say is, you know, it's a little bit like investment advice. You know, past performance isn't an indicator for future performance. Well, it's a little bit like that. You know, anything's possible. But there is no question, you know, recessions are getting bigger, more severe, and much more connected. The only other thing I'd also say is, I remember when the GFC came, it's still been a little different in COVID, but when the GFC came, I mean, the world was really negative, and we were deeply concerned, and it had quite a profound impact on our economy and what we could do for a period of time. But the one difference back then in 2008 was that China actually was the third leg of the stool, and its economy was able to grow, and it was capacity to buy goods and services and really prop up the world was quite different to where it's at today. Either the willingness to engage with China from some countries, or the change that they are making. I mean, you can see that with Xi Jinping, and the path to common prosperity is different now, and the impact that's having. So maybe China's not the life raft that it was in an 08, for instance.
Thank you, John. Next question, I think, is also for you, and it gives you the unique opportunity to move the New Zealand housing market and create lots of headlines tomorrow.
Right,
very unsurprising question. So what are your thoughts on the future of the New Zealand housing market? I mean, that had to come. The question is the most popular one. And how can housing be made more affordable? And of course, is there a potential crash coming? And where would you invest?
Yeah. Okay. So, I mean, housing, I think, for a start off, we live in a property owning democracy. People want to own a home. It's a very common basic. It's not just Maslow's hierarchy of needs. I mean, you can go and rent a place, but our society has been driven off wanting to have home ownership. There have been lots of factors driving that desire. It's not surprising house prices have gone up rapidly, and it's because as interest rates fall, people's capacity to borrow and to service a mortgage increases. And so, when you go into your bank and you look to buy a home, the two things they're worried about is what is your income level, and that's measured obviously against the interest rate. So what's your debt serviceability, and what's the likely probability you'll keep your job? That's what they're worried about. And that envelope has really blown out. I think where things might get a lot more interesting is if the Reserve Bank continues down the path, for instance, of debt to income ratios and the likes. That will be a natural controlling mechanism for how much the banks can lend. I mean, we've already taken a pretty conservative view at ANZ. We implemented higher LVR ratios earlier than some of the banks. I think we had the highest LVR ratio on investors, for instance. I think the good news part of the thing is I personally think house prices won't collapse, and I think that's a good thing, because I don't think you actually want to leave a whole lot of New Zealanders with negative equity. But I think that the rapid rise in house prices is not sustainable, and it can't and will not continue. And I think there are many reasons for that at the moment. Firstly, one, interest rates are starting to track up. Secondly, the Reserve Bank is starting to deploy other tools. Thirdly, I think that there's no question land supply is one of the big factors in resolving it's still very much a supply side equation. We don't have migration running at the levels anywhere near, we've had, in fact, it's been very, very low. And I think, so I think if you put in all of those factors, I think that house prices you're going to see house prices top out, in my view. I don't know that you see a tremendously big correction, but I think the boom runs over for a period of time.
Thank you. One of the most popular questions is actually out of order. They're asking you to run for PM again. That's also physically impossible since you can't get out of Auckland right now.
Yeah, that's right.
As we can see. Anyway, many questions actually about international economics, and especially around China. Maybe we can take them all together. There are question marks about the Chinese real estate market. There are question marks on geopolitics more generally. You've already touched on that, so maybe we start with Bryce. Bryce, where do you see China in all of this? Is China a factor in the next GFC? I mean, in the last GFC, China effectively bailed us out.
Yes, our report is fairly quiet on China, and I thought about while we're writing it, and the problem was that there's so much debt in China, not just central government, but out in the regions and in the state-owned enterprises, that I didn't feel confident enough to say a lot about it. The fact that the debt is so large and so opaque, and they've been spending so much on assets, which we're reading about, sort of almost cities, which are pretty unoccupied, makes one feel nervous. And that China's a bit of a dark horse, absolutely a totalitarian sort of government. So it will do whatever it can to bury the things it doesn't want the world to see, of which economic stress would be one. So I think it is a serious sort of risk, which is why I was watching it when that recent property collapse or property sector problem started to unwind, the big debt problem. But financial markets, around the world, in the US, New York and London and Europe, will be watching that much more closely, and they'll have much more information than me about just how bad those debt problems are. So that's where I am. Yeah, China's a potential black swan, but I don't feel close enough to it to say a lot more than that.
Thanks, Bryce. I think, John, you've always had very good connections to China. What role might China play in a future financial crisis? During the last GFC, I think actually Chinese stimulus really helped us and helped the Australians and helped prop up resources. Will China be able to play that kind of role again in the future, or is their economy now as weak as it appears?
I think the simple question is it's uncertain. I unashamedly and naturally maybe have been a China bull. And I think not just because I thought that New Zealand stood to benefit from the economic relationship with China, because bluntly, they wanted to buy a lot of what we wanted to sell. And they're very mercantile. I mean, even if you look at the standoff with Australia that's been happening in recent times, yes, they've stopped barley and beef and crayfish, but they've still been buying iron ore and steel at alarmingly high rates because it drives their economy, and they wanted them. So they're quite good at working out which bits of the economy they are important for them and continuing to support those. And in New Zealand's case, much of not only the relations been friendly, but much of what they wanted, food supply in particular, has been important to their people and their economy. I think. Notwithstanding what I said earlier about private sector debt, I mean, one of the issues with China, of course, is, it's actually okay to have high levels of debt at one level if you believe that economic growth can be sustained and that consumers are logical in what they do, and they'll, for instance, have mobility and they'll work and they won't rely on the government to bail them out of everything, all of these kinds of things. And so to a certain degree, I look at the nominal levels. Bryce is right, nominal levels of debt are very high, but on the other side, the growth rate has still been very impressive off of an increasingly high base, and they've got plenty of capacity. What I think is slightly making the international markets uneasy is that the common march to prosperity has had two sort of victims so far, which have been surprising. So firstly, as Bryce mentioned, the real estate space, Evergrande is really just the tip of the iceberg. I mean, Evergrande is very large and its debt levels are huge, hundreds of billions of dollars, but it's only one of many. And the question is, well, what does happen? And for instance, would the government be happy, for instance, to see some collapses in that area? Because maybe part of that would see actually as real estate prices come down. And that's been one of their real concerns, that real estate prices are moving ever increasingly out of the reach of a low to middle income Chinese nationals. So that's one issue. The second thing has really been in the tech space. I've been somewhat surprised actually that they've effectively, through their comments and actions, have really halved the value of their big tech sector, whether it's Alibaba, Tencent, any of these big companies now, WeChat. I mean, they've been quite an important part of their economy. Now, maybe again they consider that much of that stock or whatever is owned offshore, and so they're less worried about it. But it is an important part of their economic story that they build a smart China, and so actually a highly functioning tech sector has been really important. And then the third part of it is really around do relations deteriorate so much that particularly US companies become increasingly nervous about their investments in China. China has tried quite hard actually to sort of say that foreign investment is welcome and that it'll be treated well and all of these things, but there's a nervousness out there. So look, the simple answer is we don't know, because as Bryce said, there's no opaqueness about that. But I still think China is going to be a very, very important market from New Zealand's perspective, but they are just so large now that, they could be, that certainly if they had a problem, it would be as significant as the United States having a problem, if not more so.
So the role of China has obviously changed since the last GFC, and that will be different in the next GFC. Another factor that has changed, I think around the time of the last GFC, cryptocurrencies hadn't even been invented, and now they're everywhere. And we have a question actually from the audience about that for you, John. What's your view on crypto investment? Is that triggering or maybe contributing to a correction? And how would that actually play out in a crisis? Would cryptocurrencies play the same role that gold used to play in financial crises?
Yeah, and I think if you look in the early days of the sort of Bitcoins, if you like, of which there are many from Dogecoin or whatever down, but let's just start with
Some weird ones.
Bitcoin. Yeah, some very weird ones. I mean, Elon Musk seems to talk about them most days more than Tesla stock. So, anyway, if we look at Bitcoin, I was extremely skeptical. I sort of took the view that said, look, these things are out of the control of central banks, which they won't like. They are, there's no sense of value. They can double and triple and they can do that overnight. And you have no sense of measurement of why that value would be so much greater today than it was yesterday. So as a store of value, then not backed up by, the gold standard or something else. And then the other thing was that, look, they were used by nefarious people for either gambling or, bluntly, actually for purchases on the dark web and for cybercrime. And so I was pretty negative on the whole thing. But I tell you where I think the world is going is that I think central banks increasingly could issue their own cryptocurrencies, and if not issue them, certainly be supportive of them. So payments are almost the new black for banks. I mean, the old days, payments were a sort of a thing that we did. Nowadays, payments are a highly valuable source of revenue and an important part of the system. And if you start looking around the world at some of these new technology companies, Air Wallets is one example of that, they can make payments at a fraction of what the banks can currently through their systems make them. And so if you send money overseas and you want to do things, then actually it's both expensive and it's clunky and it's difficult. Cryptocurrencies can and almost certainly may be legitimately a very important way of world payments becoming much cheaper and far more efficient. And then on top of that, they allow a fractional ownership and fractional play that you don't get through normal currencies. So my view has kind of changed, albeit caveated by the fact that some of the earlier behaviour is still there. But I think you can see the Reserve Bank of New Zealand's already issued a paper on cryptocurrencies, and I think the central banks will play a much bigger role.
Isn't there a difference really between Bitcoin and central bank administered cryptocurrencies? Because at least Bitcoin you can't inflate, whereas central bank currencies will probably be just another kind of fiat money, right? Maybe,
but and I agree. And it's like anything in life. I mean, when you have these kinds of currencies, well, like a lot of things in life, when it becomes regulated, then it always becomes, it's more expensive and it's more challenging and it's difficult. But think about the way the world is changing. I mean, bankers may or may not love Afterpay, right? Mm-hmm. But really tell me what's different with Afterpay to a credit card. Yep, you're making payments afterwards, you're making them in equal installments, they have some differences, but fundamentally, consumers love them. Well, we live in a world now where people don't live on the super app like they might in China, but how much of the commerce that we do is not only online, but will remain online. And we live in this world where technology, whether it's buying newspapers or delivering reports like your one, that's the world we live in. And I can't tell you where Amazon and Facebook and these guys are going to end up, but what I can tell you is they could easily become part of a very globally integrated system, not only just for purchasing goods and services, but for within the payments of that. And you already saw Facebook test that, and in the initial instance that didn't work out so well. But I just, I don't know, there's a lot of money there and a huge amount of volume, and I just think over time that space is going to change dramatically, and banks are going to have to adapt. If they don't adapt, actually, their income streams are going to fall.
Thank you. Since we were just on the topic of central banks and what they might do in the digital sphere, there's a wider question on central banks. And we have a question from Andreas. Do you think central bank institutional independence is robust enough for the future? And what changes would you propose, if any? I mean, here at the initiative, we follow central bank actions with great interest. So maybe I'll start with you, Bryce.
Yes, our report does express concerns and documents the basis for that. Current developments have made the major central banks, and I don't think New Zealand's an exception, more politicised. And what's been happening is with quantitative easing has sort of blurred the difference between fiscal policy and monetary policy. And central banks are getting drawn into funding fiscal deficits. They've been able to get away with it up till now because inflation has been, the consumer price inflation has been surprisingly low. We've really been seeing it an asset price inflation. But now, you know, over the last 6 months or so, the consumer price inflation rate's been recorded in the major countries have been shooting up. And that's putting central banks into a much more difficult position. Another sign of the politicization of central banks is the arguments they're contriving to make that climate change is an imminent source of global financial instability. And it's a slow gestation thing. I haven't seen any good bit of paper yet where they've made that credible. It seems more a postulate that they're seeking research to substantiate than something moving the other way around. So that's another bit of concern about the politicization of central banks.
Thanks, Bryce. Question to you, same question to you, John, maybe slightly rephrased. Do you think Adrian Orr would make a good politician, or is he better as Reserve Bank governor?
Really go and ask Adrian, I think, whether he wants to do any of that. Look, the only thing I would say about the central banks and so the RBNZ in New Zealand is that they've certainly widened their toolbox. Does that make sense? Yeah, I think there's some arguments about not solely using monetary policy. And one of the reasons is if interest rates get low enough, as they did in New Zealand and they have around the world, then actually movements in interest rates at that level have very limited impact. I mean, is there really much difference between your base rate being 1/4 basis point and minus 1/4 basis point? I mean, other than psychologically, it's not a huge amount of difference, is it? The interesting thing I think for New Zealand will be that I think Adrian holds in his hand now the biggest wand any Reserve Bank governor has ever held in New Zealand's history. And the reason for that is that the level of private sector debt is so great, particularly in housing, that I think far smaller movements in those interest rates now on the upside will have a much greater impact on housing and on the economy than ever in our history. Certainly at ANZ, what we have done is we model interest rates and movements in interest rates and what we think is the impact on both the demand for housing and the impact on our customers' capacity to meet their needs and payments. And this will come as no surprise to you to know that, if you move interest rates, far less today than you did 10 years ago, the impact is quite dramatic.
Thank you. We have a question that might be out of order, but I'll take it anyway because it actually fits quite nicely. The question is, how do we end the hermit kingdom and get reconnect to the rest of the world? I think I'll take this question anyway, because actually when it comes to the next GFC, we want to be connected because actually trade can help us as it did last time. And we have lots of questions on trade. We have questions, for example, on how do we reconnect or better connect with the United States? Can we get a high quality free trade agreement with the US? Maybe your view, John, first.
Yeah, I mean, look, I'm on the record and I stand by what I've said. I think, in the absence of a vaccine, of course, locking down and those sort of controls and constraints made sense. But we're now at levels of vaccination which are very high globally already. And, I obviously live in Auckland, and I can tell you the feeling on the ground here is one of great anxiety with businesses. It's palpable, the feeling of frustration and sheer fear, actually, that, they're going on week after week with their businesses under such enormous pressure. And so, I think it's absolutely critical that the government names a date when we are going back to normal. I mean, we had the announcement from Chris Hipkins the other day about MIQ, home MIQ, but what we get is not what you get in Australia, that from this day, New South Wales and Victoria, you can get off the plane and have your Tim Tam and get a native flower. In New Zealand, so we'll tell you about it in Q1. It's just not credible for businesses to sit there who are globally connected and to not know the rules of engagement when you have nearly 90% of New Zealanders with either one jab and the vast bulk of them with two. And I think...
So would you say that our COVID management actually increases the chance of the next financial crisis for New Zealand?
Well, business can't operate either in the conditions it's in. It can't operate in lockdown effectively in Auckland, certainly not in most sectors. And globally, we trade to, the better part of 200 countries in the world. And what business needs is certainty. And I understand all the arguments about, that people's health is critically important. Of course it is. But if the vaccination is not the answer, then I don't know what the answer is. But what I do know is that, we at some point have to re-engage with the rest of the world. And if we don't, we will get left behind. I mean, today, an Australian business person living in Sydney can go and visit their customers around the world. A New Zealand business person living in Auckland really can't go outside the front door. That's not a fair fight.
Thank you. We only have a few minutes left, so let's do some quick fire questions with very short answers, hopefully from both of you. We'll start with you, Bryce. First question, what's your economic forecast for the next 6 to 12 months for New Zealand as we come out of the lockdowns, hopefully?
I don't have a forecast. I just go by what the professional forecasters do. So things are bowling along much as they are.
Okay, and you, John? 6 to 12 months?
Look, I think on the basis that we are able to open up and reconnect, let's just make that assumption for a second. Then of course growth will bound back from the what will be very significant contraction in Q3 and Q4 of this year. I'm not as convinced that consumers spend anywhere near the levels of money that they spent after the first lockdown. I think their resources are depleted and they're more skeptical.
Okay, next quick question. Demographics. Given declining demographics and a reduction in demand which will result, how concerned are you about deflation rather than inflation in the future? John?
Very difficult to see deflation in the short term. I mean, I think, you've got inflation being driven off both, wage growth, shortage of labour, as we can see, low levels of low unemployment rate, significant logistics issues, and still, whatever you think, very cheap money. So I don't think you're going to see deflation in the short term.
Bryce, any deflation pressures, yes or no?
Yes, for asset prices. They could really come down if interest rates go. But, hyperinflation is a possibility in some countries to get rid of the public debt problem.
Right. Question about should the government create a future investment fund to help make future health and education infrastructure more affordable, John?
Like anything in life, saving for something you want in the future is a good idea, but I think, but I just don't think it's credible. I mean, we borrowed $50 billion in the last year. I mean, I always remember the argument about that we should have borrowed to fund the super fund, and my economic advisor at the time used to say to me, well, if that's such a great idea, then why don't we just go and borrow hundreds of billions? And the answer is you don't know performance of a future of a fund. I mean, we do know that, in those years, asset prices did rise, but, they may well have equally fallen. I think the most important thing is we have to get back to basics, get the economy open, get government spending under control, and turn New Zealand into a smarter, globally connected economy. We have to make our way in the world. We can't just have, so much money being borrowed as the shield for what's really happening underneath the hood, which is, we have to make our way in the world, not borrow our way in the world.
Right, I think I know you well enough that you would probably agree with everything John just said. Is that right?
Yes, that's right. Yes, I hope they do it with someone else's money.
Okay. Another quick question. In this week's financial stability report from the Reserve Bank, the RBNZ maintains its focus on climate change. Climate change is real, of course, but are there other more pressing risks from the Reserve Bank's point of view, John?
Well, a lot of New Zealanders might say housing in the short term is one of the issues, which obviously the government's given them great authority over. I mean, I'd say, look, in general, what I look to the Reserve Bank for as a consumer, or as chairman of ANZ, is good economic leadership and a well-functioning banking system, because without that, the rest of the economy isn't going to operate well. We just live in a world, whether people like it or not, climate change is going to be an issue which it will have varying times. In the last 12 to 18 months, COVID-19 has been the thing that we talk about and focus on every day, but climate change has still been there, and climate change will at varying times be front and center stage. And I think we do need to deal with those issues, and I think it's always a balancing act, but it's just something we can't ignore, unfortunately, because there will be repercussions for us, as a country, if we don't take our responsibilities seriously.
Thank you. Final question from Damien Grant. So you have a chance to help him write his next column for Stuff. From a trading environment, what are the potential black swans that are lurking in the background that could explode into consciousness and trigger a crisis? So I guess if we knew the black swans, they wouldn't be black, would they? But anyway, Bryce, do you want to have a go at it first?
Well, the Taiwan one I've mentioned, are there ones which aren't in the public domain? Well, there will be, but I don't know of them. As I said before, I think when a system's in a fragile state, the little straw on the camel's back that brings it down may not be predictable.
John, what's keeping you awake at night? What worries?
Well, I mean, look, one would be what happens if the pandemic morphs into a different space. I mean, Delta has been a different variant of COVID-19, but by all accounts, the vaccines work against it, and it's been effective, and so far the thing hasn't mutated in a way that has surprised people dramatically, as I understand it. But the first would be, what happens if you really did see something that was debilitating and we were back in level 4 lockdowns, or the equivalent of globally? So that would be the first issue. I think the second is, geopolitics definitely does run a risk. Maybe not even always the ones that you predict. I mean, people sit around and say they spend a lot of time talking about Taiwan or Hong Kong, but maybe it's not as simple as that. Maybe it's something else that we don't see. I mean, again, housing is not exactly a black swan, but it's the biggest asset that people own. I don't think you get a collapse there, because I think, as I say, it's fundamentally underpinned by interest rates, which are still under the control of the Reserve Bank. I mean, if the house prices got bad enough, they can cut interest rates, and by jobs look pretty secure. But again, cyber is an interesting one. Cyber's sort of innocuous at the moment. It affects companies, and there seems to be a bit of a rolling wall of a denial of service tax and various different things that we've seen around New Zealand. But I don't know what happens if you saw something really major. They really could, close down the functioning of the world. I mean, look, ultimately, a black swan event happens when people are not only just surprised, but when it rocks their raw confidence. And at the moment, we've, between governments and central banks, done a pretty good job of making people feel as comfortable as you practically can. But as I say, look for the unexpected, because that's what really throws people off.
Oh dear. So we started with predictions of the next global financial crisis, and we finished predictions of perhaps future cyber attacks and global unrest. Anyway, you managed to keep the audience, so we still have more than 300 people on the call, but we have to end it here. Thank you to Bryce and thank you to John. It was great to talk to you, and please read your report. It's on the website at initiative.org.nz, and it's by Bryce Wilkinson, Leonard Hong, Walking the Path to the Next Global Financial Crisis. And for all of you, just a hint, there will be another webinar on the 2nd of December. We are fortunate to have John Cochrane from the Hoover Institution at Stanford University, and he will talk to us about what central banks should do, and perhaps more importantly, what they shouldn't do. So we'll send you the registration details in the coming days, and then we hope to see you again on the 2nd of December, 11 a.m. But for now, thanks again to Bryce. Thanks to you, John, and it was great to talk to you. And I hope we can see you in person again once you get out of Auckland. Yep. And thanks for joining us, and thank you all for watching, and have a great day. Thank you. Bye-bye.